So a business transaction to be accounted or to be considered in bookkeeping should be mensurable in money. We are coming to a huge concept called the money measurement concept. A transaction which has a financial impact on the cash, on the bank, on an accrual, deferred payment, financial implication only would be recorded in the books of account. We had taken the example last time of commencement of business or introduction of capital. Introduction of capital was one. We had come to opening a bank account. Look at these transactions. Then we had come to purchase of plant and machinery. Plant and machinery purchased. Then we had come to raw material purchased. Purchase of input to be converted into output. And we had come to appointment of workers or laborers. This particular transaction or activity lacks money measurement or measurability. So this transaction would not be entered in the books of account. You may have other records for it, but it does not have a financial implication. So a business transaction to be recorded or accounted or booked for should be measurable in terms of money. It must have a financial denomination. Commenced business with cash of 2 crores, furniture of 45 lakhs, purchased plant of 1 crore, paid wages of 80 lakhs, invested in shares of another company, made a fixed deposit of 50,000. So all these are transactions which have a financial impact. So there are various transactions entered into by a business during the accounting year, some of which have a monetary implication, some of which do not have a monetary implication. I am not saying that a transaction without monetary implication is not relevant or not important. They are. But the only thing is, they are not accounted in the accounting records or in the books of account. You will have to keep a track of them separately, maybe for legal purposes, for future reference. So I am now interested only in transactions having a monetary, a financial obligation or right. When I say a transaction which is measurable in money or which can enable money measurement, there is a right or a liability of the business. For example, when I introduce capital, money comes into the business. So the business encashes on a right. When you open a bank account, there's an obligation to pay money into the bank. The banker opens an account in favor of the business. When you purchase plant and machinery, there are various methods by which it can be purchased. I purchase plant and machinery, let us say giving an advance with the promise that the balance will be paid 2 months later. Number one. Number 2, I may purchase a plant or a machinery item, making the payment immediately across the counter. Number 2. Or number 3, I purchase the plant and machinery on an installment basis, where I keep paying for this every month. Ultimately, all of them have a financial implication. The last one, purchase of a plant and machinery with a promise to pay the amount 3 months later. That is called a credit transaction. So a financially measurable, a money mensurable accounting or financial transaction creates a right or an obligation. A right for one is an obligation for the other, and the vice versa. So ignoring the last of them, ignoring the appointment of workers, which is also a business transaction. I wouldn't like to call it a transaction, it is an activity. The others are business transactions. And it is the business transactions having the money impact which are recorded in the books of account. So we have analyzed now in a business what is to be recorded. Then we move on to how it is to be recorded. So remember, I will only be recording those business transactions which have a monetary impact, a financial impact on the business. The business is paying money or receiving money or promising to pay money or is promised to be paid money. Whether at one go or in installments, a part now, a part later. Anyway, there is a financial impact. So there are so many transactions which are not relevant for a business. Like, let us say, the chief manager of a business retires. He may have worked with the business for about 15-20 years. When he leaves, when he retires, when he resigns, when he is removed, it will bring about a significant impact on the business. But it is not amenable to money measurement. There is no financial impact. Of course, you may have to pay him gratuity. You may have to pay him his salary. You may have to pay him his provident fund. Those financial impacts are considered. But the retirement of a manager by itself does not have an impact on the books or records of that business. So the lesson that we learn is, you need a transaction which is measurable in terms of money to have an impact on the profit or loss. So these are the transactions that I would be considered. That is the introduction of capital, the opening of a bank account, plant and machinery purchased, raw material purchased, such transactions which have an impact are accounted in the books. So now you know what transaction to be recorded, what transaction not to be recorded or ignored, at least for the purpose of accounting. Now, every transaction that is entered into will incorporate or have a double effect. For example, when capital is introduced into a business in the form of cash or assets, the two aspects that are affected are capital and, let us say, cash. A businessman commences business with cash of 2 crores. Capital and cash. Opening of a bank account. When you open a bank account with State Bank of India, the two aspects that are influenced are The bank account and cash. I get a bank account created by paying cash. In a sense, it is the generation of an asset. My bank account becomes an asset for me to channelize my revenues and expenses hereafter. I am constructing a financial platform for receiving and paying money. So I must have a margin in that account for which I keep paying money into it. So either I pay or my customers pay. So a bank account and cash are the two aspects or legs of this transaction. Look at the purchase of plant and machinery. Suppose I am purchasing plant and machinery by paying money. Plant and machinery is one and cash is the other. Plant and machinery comes in, cash goes out, or I pay in the form of a check, or I promise to pay the supplier of plant and machinery on a future date. It is a credit transaction then. I purchase raw material. I have goods and cash which are affected. So after having understood that, money measurability is important, or factor number one. What we study next is breaking up every business transaction into its two affected concepts. What are the two concepts or the legs of the transaction which will be influenced? So, by that account, there could be receipt transactions, there could be payment transactions, there could be investment transactions, there could be credit transactions. So every transaction is either a receipt, when I say receipt, I mean receipt of money, or a payment of money, or a credit transaction, or an investment transaction, or a loan or its repayment transaction. So all these indirectly influence the financial element. There is a financial obligation, a right, a liability, a duty created. So every business transaction which is measurable in terms of money should be split into its two parts. One will be technically, in the accounting language, debited, and the other would be credited. These are the first two pillars on which accountancy stands: the debit and the credit. Debit is an obligation, credit is a right. Debit is something that comes into the business. Credit is what goes out of the business. Debit is an expenditure. Credit is an income. So many such aspects coming up after identifying the two elements in a business transaction. So every business transaction has at least two elements, one of which has to be debited, or some of which have to be debited, and one of which has to be credited, or some of which have to be credited. That is the accounting principle. So in order to debit or credit an account or something, what are the accounts affected? What are the accounts which take a bearing of the transaction? Must be analyzed first. So we understand different types of transactions and then come to the debit and credit, which are the two pillars of accountancy. Debit and credit are used as nouns as well as verbs. An account is debited, we say, or we say this is a debit transaction, or this is the debit leg of the transaction. Or on the other hand, we say an account is credited, or that this is a credit transaction. Verb, noun, either way. Just like expense. Accountants use the word expense also as a verb. Expense it means charge it off to the expenditure of that particular accounting period. So let us not hurry up, let us go back to the basics. Business, which is a comprehensive term including vocation, profession, trade, etc. Incomes and expenses, financial year or accounting period, transaction, money measurement, and the two legs, the two accounting legs of a transaction to be identified. So the next job is to pick up transactions one after the other. Identify the various business transactions and applying the rules of accountancy, debit or credit those legs or accounts to summarize the net impact at the end of the accounting period as a profit, a loss, or the resultant financial position. So it is the transactions which are measurable in terms of money only which are to be considered, and there the money impact is on two different factors or two different legs. Identify them. Like when capital is introduced or business is started, capital account is affected, cash account is affected. When a bank account is opened, bank account is affected and cash account is affected. When plant and machinery is purchased, plant and machinery account is affected and cash account is affected. Similarly, when raw material is purchased, goods is affected and cash account is affected. Here is a transaction in which, here is a set of transactions in which one leg in each case is the cash account or the cash balance of the businessman. So these transactions have to be split into the two legs, one of which has to be debited and the other has to be credited, applying the principles of accountancy. So we would be taking up and analyzing plenty of transactions hereafter to identify the accounting principles or the method of accounting.